What if I told you the downfall of the average retail trader often begins in the first 5 minutes of the trading day? It sounds too simple to be true, but I've seen it play out again and again. Picture this. The average retail trader is sitting at his desk, coffee half finished, screens glowing with charts. He's convinced today is his day. The opening bell rings. A stock explodes 10% higher right out of the gate. Social media is on fire. Twitter, Reddit, Discord. Everyone's chanting the same word, buy. And in that moment, the trader feels it, that pulse of urgency. That whisper in the back of his mind, if I don't act now, I'll miss it. So he clicks, he buys, and for a few shining minutes, it feels like he made the right call. His account is green, his heart rate spikes. But markets have a cruel way of teaching lessons. By midday, that stock rolls over. The volume dries up. What was once a rocket ship turns into a slow-motion fall. He stares at the screen, frozen. The gain vanishes. Now he's down 5%, 10%, 20%. And here comes the hardest part. He doesn't sell. He can't. Because selling means admitting he was wrong. Hours later, the account is bleeding red. He's exhausted. He's ashamed. He tells himself, I'll just hold until it bounces. But deep down, he knows he's trapped. That exact spiral is why so many traders never survive their first year in the markets. And it's the reason I'm making this video. Because the truth is, you don't have to trade that way. There is a different path. A calmer, more disciplined path. And once you see it, you'll never look at the market the same way again. My name is Ben, and welcome to Zenstock, where trading meets clarity. Here we focus on mastering your mindset as much as your charts. You'll learn to think differently, manage risk, and trade with calm confidence. Because in the market, your greatest edge is you. This content is for education and entertainment only. It's not financial advice. Always do your own research before trading. Before we dive in, take a deep breath. Clear your mind. For the next few minutes, give your trading psychology your full attention. I didn't figure this out alone. Years ago, I came across a book that completely reframed how I looked at market cycles. Stan Weinstein's Secrets for Profiting in Bull and Bear Markets. Weinstein had this way of stripping the noise out of trading and showing the raw psychology behind every chart. I remember reading it and thinking, this isn't just about patterns, it's about people. About fear and greed moving prices long before the news ever hits the headlines. Weinstein understood that charts don't lie because they're not emotional. Traders are. And once I saw that, I couldn't unsee it. Every gap up, every sideways churn, every sudden breakdown. It wasn't random. It was the same story repeating through time. The only question was, would I learn to read the story before it was too late? Not long ago, I was chatting with a trader in a Discord room. He wasn't new to the market. He'd been around for a couple of years, but his results felt like a coin flip. Some wins, some painful losses, never really pulling ahead. That morning, he was watching Upstart Holdings. Not exactly a household name like Tesla or Apple, but a stock that can move 20% in a single session if the right catalyst hits. He messaged me, this looks like easy money. It's basing out. Feels like it's ready to rip. I could sense the excitement through the keyboard. His plan was simple. Jump in before the breakout, ride the wave, and sell into strength. But here's the catch. He wasn't looking at the bigger picture. The 30-week moving average was still sloping down. The chart was whispering caution, but his emotions were screaming urgency. He bought in. At first, it looked like he nailed it. The price ticked higher, green numbers on the screen. He typed, see, this is it. Finally caught the move. But then the volume dried up. Sellers stepped in. The stock rolled over like a car running out of gas halfway up a hill. A few hours later, his messages had shifted. Should I just hold? It can't go much lower, right? That spiral of doubt is one I've seen countless times. The average trader convinces himself that patience will fix a bad entry. But patience without a system isn't discipline. It's just hope. And hope is not a strategy. That Discord conversation stuck with me. Not because the trade went bad, I've seen hundreds of those, but because it showed the exact trap the average retail trader falls into. Chasing breakouts without understanding the stage of the stock. Ignoring the slope of the moving average. Trusting excitement over evidence. And that's exactly what we're going to break down today. This isn't about hot picks or quick tips. It's about building a mindset and a framework that keeps you from making the same mistakes over and over again. We're going to walk through how to spot the real signals in both bull and bear markets, how to use stage analysis to know when to enter, when to hold, and, most importantly, when to get out. And along the way, I'll show you the psychological traps that destroy most traders long before their charts ever do. Now, before we go further, this is not financial advice. I'm not here to tell you what stock to buy or sell. I'm here to share lessons, stories, and frameworks that have stood the test of time. What you do with them is up to you. So here's the big takeaway, the one line that I wish every trader could burn into their mind. Trading is like sailing. The wind will always shift, the waves will always rise and fall. You can't control the storm, but you can control your sails. Most traders, they throw their sails in the wrong direction. They fight the wind, they chase every gust, and then wonder why they're shipwrecked. But the ones who last, the ones who grow accounts instead of blowing them up, they learn to adjust, calmly and systematically, no matter what the market throws at them. And that's what this framework really is. A way to read the weather. A way to align with the current instead of fighting it. Because once you see the market through stages, not random noise, not headlines, not hype, you'll realize you're no longer guessing, you're navigating. Lesson 1. You never set sail without checking the tide. In trading terms, that means the overall market trend comes first. Always. I learned this the hard way. Years back, I was convinced I'd found the perfect setup. Beautiful base, clean breakout level, everything I wanted on the chart. But here's the problem. The market itself was trending down, and like clockwork, that perfect stock broke out for 2 days, before collapsing straight into a stage 4 decline. Stan Weinstein wrote about this decades ago. If the tide is going out, even the strongest swimmer gets pulled under. His rule was simple. Don't buy when the overall market is bearish. Don't fight the current. Now here's where psychology sneaks in. Traders love to believe they found the exception. Overconfidence whispers, my stock is different, my chart is stronger. But 9 times out of 10, it isn't. And that illusion of control, the belief that you can outsmart the tide, is what wrecks accounts. I've seen it in mentoring sessions. A trader swears their breakout is bulletproof, only to watch it crumble when the indexes turn red. They don't want to admit it wasn't the stock, it was the tide. So here's the rule I give them: before you buy anything, zoom out. Look at the market stages. Is the index in stage 2 advancing? Or is it in stage 4 declining? Because that one decision, aligning with the tide, does more for your survival than any fancy indicator ever will. And when you start seeing the market this way, something shifts. You stop feeling like you're drowning in randomness. You start feeling like a sailor reading the wind. Aware, prepared, calm. Lesson 2. Not all waters are equal. Even if the tide is in your favor, you need to pick the right channel, the right sector. I remember one trader I worked with during the reopening boom of 2021. He was obsessed with airline stocks. He had charts, news clippings, even spreadsheets full of passenger data. He was convinced this was the sector to own. But the charts told a different story. Airlines were chopping sideways. Volume was weak. Meanwhile, semiconductor stocks were breaking out left and right, showing strength every week. He ignored it. He anchored on his story. And while semis doubled, his airlines barely moved. That's the pain of confirmation bias. You find evidence for what you want to believe, not what the market is actually showing. Weinstein nailed this point. 2 charts can look equally bullish, but the one in a strong sector will often soar, while the one in a weak group barely crawls forward. It's like paddling upstream versus downstream. You may be moving, but the effort and payoff are completely different. So what's the psychological trap here? Ego. We tie our identity to a sector or story. I called the airlines. I did the research. But the market doesn't care about our identity. It only cares about supply and demand. The simple rule, always ask, which groups are leading? Put your energy where the flow is strongest. Don't paddle against the current just because you like the scenery. And when you finally shift into the strongest sectors, something magical happens. Your trades feel lighter. They move faster. It's not because you've suddenly become a genius. It's because you've stopped fighting the current and started riding with it. Lesson 3. Timing matters more than most traders want to admit. You can have the right market, the right sector, even the right stock, and still lose if you enter at the wrong stage. I saw this play out with a trader who jumped into plug power during the clean energy hype cycle. On paper, it looked unstoppable. Headlines everywhere, analysts upgrading, everyone convinced it was the future. But here's the thing. It was already deep into stage 3. The stock had run hard, the moving average was flattening, and volume was turning choppy. I warned him, this isn't the early breakout anymore. This is late game. Be careful. But he couldn't let go of the excitement. Loss aversion kicked in before he even took the trade. He was afraid of missing out more than he was afraid of losing money. So he bought. And what happened? The stock churned sideways, then cracked into stage 4. He held on, telling himself, it'll bounce. It always does. But bounces in stage 4 are traps, not opportunities. By the time he finally sold, most of his gains from the last 3 months were gone. Weinstein's system makes this clear. Stage 2 is where the real money is made. Stage 3 is distribution. Stage 4 is destruction. Yet the average retail trader jumps in right as stage 2 is ending. Because that's when the news is glowing, the story is exciting, and everyone around them is bullish. The trap here is recency bias. We mistake the last 6 months of gains for proof that the next 6 months will look the same. But markets don't work that way. They cycle. They always have. They always will. The discipline is this. Wait for stage 2, not stage 3. Don't chase excitement, chase alignment. Because the chart will whisper the truth long before the headlines catch up. Lesson 4. Survival comes before success. Because in trading, you don't get to win if you're already out of the game. I once knew a trader who was brilliant at picking entries. He could spot stage 2 breakouts with uncanny precision. But there was one problem. He refused to use sell stops. He told me, I don't like being forced out. I'll know when to exit. That worked fine, until it didn't. One day he was holding a small cap stock that looked strong. No news, no red flags. Until the company announced a surprise share offering after hours. The next morning, it opened down 30%. And because he had no stop in place, he froze. He told himself, I'll just wait for it to come back. But it never did. What should have been a manageable loss turned into a devastating one that wiped out half his account. Weinstein hammered this point. Never hold a stock without a protective sell stop. It's not a suggestion. It's the lifeline that keeps you in the game. The psychology here is ego. We hate the idea of being wrong. A stop loss feels like public proof of failure. But in reality, it's the opposite. It's proof you're disciplined. Proof you value survival over pride. And the truth is, every professional trader I know uses stops. The difference between them and the average retail trader is simple. Pros see stops as insurance, while amateurs see them as punishment. So here's the shift: start treating stops as a seatbelt. You don't put on a seatbelt because you expect to crash. You wear it because you want to walk away when the unexpected happens. Do the same with your trades. Place the stop, accept the small loss, and live to trade another day. Lesson 5. Knowing when to sell is just as important as knowing when to buy, maybe even more important. I'll never forget a conversation I had with a trader who held Zoom all through 2020. He bought in early, rode the stage 2 wave, and watched his account grow faster than he ever imagined. But when the stock started topping out in 2021, the signs were clear. Volume was heavy, the chart was churning sideways, and the moving average began to flatten. Classic stage 3. I told him, this is where discipline matters most. Take some profits. Protect what you've built. But he didn't want to hear it. The stories were too good. Remote work was the future. Earnings were strong. Everyone was still bullish. He anchored to the narrative and ignored the chart. So he held. And when Zoom slid into stage 4, he rationalized every step lower. It'll bounce. I can't sell now. I'll lock in losses. By the time he finally let go, most of his gains had evaporated. Weinstein said it best, no matter how glowing the fundamentals, no matter how convincing the story, you never buy in stage 3 and you never hold in stage 4. But most traders do exactly that because of one psychological trap: loss aversion. The pain of realizing a gain is gone, or that a loss is real, is so sharp that we delay the decision, hoping the market will rescue us. Here's the reality: the market doesn't rescue anyone. Discipline does. If you're in stage 2, ride your winners and trail your stops. If you see stage 3 forming, protect your profits. And if it slips into stage 4, get out, no matter what your ego is whispering. Because selling isn't about giving up. It's about moving on. It's about freeing your capital and your mind so you can catch the next stage 2 before it's too late. Here's why all of this isn't just theory. The patterns we've been talking about. Stage 1 through stage 4, the traps of buying too late, selling too late, or refusing to use stops, show up again and again in both history and research. Take the dot-com bubble. The Nasdaq ran up more than 400% in just a few years. Classic stage 2 euphoria. But once it rolled into stage 3, traders convinced themselves the internet would change everything overnight. They ignored the churn, ignored the flattening averages, ignored the warnings, and when the decline hit, stage 4, it erased almost 80% of the index. Or look back at BlackBerry during the smartphone wars. For years it was the leader. Traders saw every dip as a buying opportunity, convinced it would reclaim its dominance. But by the time Apple and Android reshaped the market, BlackBerry had already slipped into stage 4. The fundamentals sounded strong: enterprise contracts, loyal users. But the chart told the real story: lower highs, heavy volume sell-offs, and a relentless decline. Those who ignored the signals held on for years, watching their investments sink from triple digits to single digits. Behavioral finance has proven time and again, traders aren't losing because they don't know enough. They're losing because they can't control themselves. And that's why frameworks like Weinstein's matter. They strip out the emotion. They give you rules to follow when your brain is screaming something else. And they put you back in control of the only thing you actually can control: your decisions. Now, let's talk about the traps. Because no matter how many times traders read the rules, psychology has a way of pulling them off course. The first trap is ego. I knew a trader who built his entire identity around penny stocks. He followed one of those well-known YouTube gurus who promised 10 baggers if he just held long enough. At first, he caught a couple of small wins, and suddenly he believed he'd found his edge. But the reality was different. Those stocks were thin, volatile, and mostly in decline. His ego wasn't trading charts anymore. It was defending the idea that he had cracked the code, and that made him blind to the risk. The second trap is recency bias. I saw this during the rise and fall of solar stocks. When they were rallying, every dip was treated as the buy of the decade. Traders assumed the last 6 months of gains guaranteed the next 6 months would look the same. But markets don't move in straight lines, they cycle. And recency bias convinces traders to bet on yesterday's trend just as it's about to die. And then there's the sunk cost fallacy. This one is brutal. I remember a trader holding Nokia years after the iPhone had already won the war. His logic? I'm already down too much to sell now. I'll just wait for it to come back. But it never did. What should have been a controlled loss turned into a total collapse because he couldn't walk away. These traps, ego, recency bias, sunk costs, are invisible anchors. They tie you to bad decisions long after the chart has given its verdict. And unless you learn to spot them, you'll end up trapped in the same cycle as every other average retail trader. So what do you actually do with all this? You give yourself rules. Not vague intentions, but hard lines you won't cross. No matter how tempting the story, no matter how loud the crowd. Here are the rules I live by. Never buy a stock trading below a declining 30-week moving average. I don't care how cheap it looks or how good the news sounds. If the tide is going out, I stay off the beach. Never buy late in stage 3. By the time the story hits the headlines, the smart money has already sold into the hype. I'd rather be late in stage 2 than early in stage 4. Never hold without a protective stop. The market doesn't care about my feelings or my plans. A stop is my insurance, my seatbelt. It keeps me alive when the unexpected hits. And here's one more. Never bet on a sector just because I like the story. I follow strength. If semiconductors are breaking out while airlines are stalling, I go where the flow is. My ego doesn't get a vote. These aren't just tactics, they're guardrails. They keep me from drifting back into the traps that sink the average retail trader. And once you set your own guardrails, trading stops feeling like chaos and starts feeling like clarity. Now let me ask you this. How many times have you bought into a stock just because everyone else was talking about it, without even checking the bigger trend? How many times have you held on to a loser because you couldn't stand the idea of locking in the loss? And how many times have you told yourself, I'll just wait for it to come back, only to watch the stock sink lower and lower? Be honest. Do you have rules written down? Or are you still trading on hope, on hunches, on other people's opinions? The market has a way of exposing our habits. If you've been drifting, chasing, hesitating, this is your wake-up call. Because the difference between the traders who last and the ones who don't isn't intelligence, it's discipline. So ask yourself, are you ready to stop trading like the average retail trader and start trading with clarity? If this hit home for you, don't just nod and move on. Write it down. Write one rule you're going to hold yourself to starting today and drop it in the comments. I want to see what you're committing to. And if you know a friend who's been struggling, who's been chasing trades, holding too long, or blowing up accounts, share this video with them. You might save them from years of frustration. If you found value here, like, share, and subscribe. This is how we grow a community of traders who put discipline before hype. Master your mind, master the market, trade with confidence, and live with calm.